We will easily prevail. We're already substantially ahead of our time projections, but whatever the time is, it's okay, whatever it takes.
President Trump speaking at the White House as the fallout from the conflict in Iran spreads across the Middle East. You're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We're counting down to the open up markets in Greater China. Let's have a look at your top stories today. President Trump refusing to put a fixed timeline or even rule out boots on the ground, while his Defense Secretary Pete Hegseth rejects the idea of fighting into an endless war.
Natural gas prices surging to the highest in years as Iranian drone attacks force Qatar to halt production of the world's largest LNG export facility. Chinese stocks, meanwhile, set to bounce higher after a drop on Monday.
Now, Qatar among the Gulf states lobbying U.S. allies to persuade Trump to keep the conflict short, while China also urges Iran to rethink attacks on its neighbors.
Meanwhile, the U.S. mulls capping the amount of Nvidia hardware Chinese companies can buy, further constraining the chip makers' efforts to tap the market. It's day two of us really still assessing the market impact from what's been going on in the Middle East. We were just talking about that shelter-in-place sort of alert that happened in the embassy in Riyadh. So that certainly is the latest when it comes to that side of things. But you're hearing about energy assets in the Middle East getting hit. You're seeing gas prices surge in Europe, and now there seems to be a bit of an inflationary scare among these markets too.
It's playing out, right? So I think you had a massive move up in the break-even rates. We're looking at yields just about globally on the way up. There's separately on the inflation print, also on the story in the Middle East. Leading the pop right now in the bond markets is Aussie short-end yields, right? Because that's a separate story and it pertains to their willingness and openness to respond with policy to contain inflation expectations. There's that, of course. We're hearing, of course, LNG prices to the upside, shipments and rates are being quoted more than double what you normally see. So there is an inflationary impact that is starting to creep into the narrative right now. So it's leading to bond yields on the way up. And the interesting thing, we just had a look at this, the first rate cut, the next rate cut out of the Fed was pushed back by about a meeting from, I think it was July before the weekend. We're now looking at September on that.
Yeah, if you're talking about elevated energy prices for who knows when, it certainly is going to make it much harder for central banks to cut rates, right? Especially the Fed. And the Asia impact to all of this is quite interesting as well, given the fact that they do import a lot of this LNG from the Middle East. I think it's roughly about a quarter. So it seems like traders, you're seeing them really kind of scramble to look for sort of alternative cargoes here right now. And what this means, how long this sort of disruption could last. We're going to have a shipping guest coming up to talk a little bit more about all the disruptions that they're seeing across the board. We've also had some conflicting messages out of Washington about really how long the war with Iran might last.
We have the strongest and most powerful by far military in the world, and we will easily prevail. We're already substantially ahead of our time projections, but whatever the time is, it's okay, whatever it takes.
Our ambitions are not utopian. They are realistic. This is not Iraq. This is not endless. Our generation knows better, and so does this president. This operation is a clear, devastating, decisive mission.
Yeah, so the conflict is the main artery right now when you look at markets. So Brent is just coming online. We're better by about 1.5%, 1.2 in dollar terms to the upside. Obviously, the entire energy complex is moving to the upside because it now has moved into, as Yvonne is pointing out, gas and Qatar in the mix here. Very quickly, have a look at where we are as far as the dollar is concerned. The twos and tens, we talked about this massive melt up in yield. It's not just there. We're looking at across the region with Oz short end yields higher by double-digit basis points today. We're looking at the U.S. 10 giving back a little bit right now, or the U.S. 2 rather. In case you missed that stat we just mentioned earlier on, so the next rate cut out of the Fed has been pushed back by a full meeting to now September is being priced as the next one, fully priced as the next one. Equity markets, interesting story here because you do have, of course, broader risk aversion still as the prevailing theme across these markets. Asia's down 0.9 to 1%. Europe got absolutely clobbered yesterday, so we're tracking, of course, futures there. Within the space, though, Korea's catching down. Separately, there's an Nvidia story that's showing up in some pockets of the Japanese equity market. And China's actually looking to open better, relatively speaking, compared to what we're seeing across the region. In fact, A50 futures are coming online. Looking at Shanghai oil prices, wow, okay, there we go, 11% to the upside on Shanghai crude. A50 futures are pointing to the upside, and we're looking at dollar China. Yes, that's correct. We're now trading at 690. We're back to 690 on the exchange rate there.
Yep. Okay. We are just tracking some lines that are crossing here with J.D. Vance, the vice president of the U.S., has been making comments to Fox News and maybe talking a little bit more about the rationale and maybe the timing of why the U.S. and Israel decide to strike on Iran. And he says, Trump wanted to make sure that Iran never had a nuclear weapon. There has been a lot of talk of whether, they were striking at a moment of weakness for Iran, or was this really about this nuclear capabilities that needed, or there was a move for necessity to kind of strike the Republic. But certainly they're talking about the U.S. has a lot of capacity in Iran. That's according to J.D. Vance here this morning. Let's get the latest now with Derek Waldman. He is our Bloomberg senior editor. Obviously, we're continuing to hear maybe that there could be more explosions or, alerts at least coming out from the U.S. Embassy in Riyadh as well. But just get us up to speed on what's the latest, Derek.
Yeah, Yvonne, we're currently, it's about 5 o'clock in the morning in Dubai, and so across the Middle East, we're just before sunrise, and we're still hearing reports of activity going on throughout the night over in that part of the world. You're talking about explosions and trying to figure out sort of where things are going, and a lot of kind of people just not sure as we're still in the night hours. The sun is going to come up fairly shortly. There will be assessments of damage and things of that nature. It does appear, according to the Saudi Defense Ministry, that there was an attack by a pair of drones on the U.S. Embassy in Riyadh. They're suggesting minor damage. They're still waiting on assessments there, but you're seeing from the White House and the American Day and from the State Department words committing to do what's necessary, kind of trying to put a little bit of a limited time frame on the overall thing, not trying to signal that there's any desire to be in a protracted war or conflict, but at the same point pledging to do whatever it takes, in terms of this operation.
Derek, we're just to mark more of these lines coming through out of the U.S. Vice President here, talking about how President Trump has clearly defined what he wants to accomplish. What question marks, has he, I think, what have you seen in as far as has he spelled out the objective here, apart from obviously the nuclear issue that Yvonne just pointed out? Do we understand why we're here in this situation? Because that goes in some way to seeing where the possible off-ramp might be, Derek.
Yeah, we've heard a number of comments from the White House and senior administration officials during the day, in the American Day, and there have been a varied range of things. Let me be really clear, a varied range of things. The White House has said that the goal here is to degrade Iran's capabilities. Trump has said for a long time that the U.S. did do so with the nuclear program with prior strikes, but there was some concern they were saying about its capacity to go. We heard some administration officials talking about the idea that they believe that potentially Israel was going to act regardless, and if that happened, then the U.S. was going to have to defend itself because Iran was going to sort of come back at the United States. That was one of the arguments that Marco Rubio put forward. I will say Democrats generally in the United States have been very dismissive of a lot of these justifications, saying that there's not a justification. Democrats are going to look to force a vote on war authorization later this week. There does not necessarily look like they're going to have the votes to be able to stop this in any sort of way, but going to try and put people on the record. And initial polls that we're seeing out of the United States are suggesting some widespread skepticism here. Remember, Donald Trump ran for office as somebody who wanted to limit the number of U.S. Entanglements abroad, and certainly this is a full-scale, move forward, a very, very large military operation. So there's a lot of there's a lot of questions, there's a lot of sort of disquiet, but those are some of the things that we're hearing out of the administration. As they say, in an election year, a lot of skepticism from the party opposite.
Derek, thank you. Derek Wallbank, our senior editor there, with the latest on the actual conflict front. Lots of things are happening. My screens are split between energy prices and and inflation headlines, monetary headlines, equity markets. So we're looking at most of these angles, and it's hard to really keep up. In case you missed the move overnight, that massive move in energy prices over in Europe, right? We're not talking just low double digits. We're talking 40, 50% in many cases. It's now graduated the conversation into gas, with Qatar now involved. In fact, nat gas prices surging there after Qatar Energy shut its LNG production hub there following attacks on its Ras Laffan complex. Iranian attacks, of course, have impacted other energy assets also in the region. To help us get us up to speed on that front, Stephen Sapczynski, who leads our Asia energy coverage, joins us from Singapore. Stephen, talk to us about the gas angle now. Where are we?
Yeah, I mean, I think I just want to kind of take a step back. I've been covering LNG, looking at the market for about 15 years, and I've never seen such a large outage in my career. I've talked to other traders. This is likely the largest LNG shutdown, an unplanned outage in the history of the industry that spans over 50 years. The Ras Laffan complex provides 20% of global LNG supply. And to put that into context, Qatar is the second biggest supplier of LNG on Earth, just behind the United States. So without that supply, you're obviously going to see an increase in prices. And now the focus is, how long is this facility offline? It has 14 production trains. It has staffs of thousands. Can they bring it back online quickly if there is some sort of peace deal? Is the facility damaged? That's unknown because there was an Iranian drone attack. They didn't give very many other details. And also, the last thing is the Strait of Hormuz also an issue going forward, because LNG traffic through the Strait of Hormuz shut essentially since Saturday. Not a single ship has gone either way due to war risk, insurance issues. Everyone is scrambling, and the biggest buyer of Qatari LNG is Asia. 4/5 of all LNG that comes out of Qatar reaches customers in China, India, South Korea, Taiwan. Pakistan, for example, 99% of its LNG imports come from Qatar. So suddenly we're seeing a situation where if this lasts weeks, months, you're going to see an energy crisis in the developing world. You're going to see higher prices in the developed world because they're going to be vying and outbidding each other to get the LNG that's on the water, that limited spare capacity that's available. And you're also facing gas shortages in large swaths of industries and maybe in worst case scenarios, households. So this is a big deal.
It certainly is. I know you've been covering LNG for a very long time, Stephen. Tell us a bit more about those alternative cargoes. I mean, is there enough capacity outside of Qatar, for example, in the Middle East, to offset what you've been laying out?
There is not enough capacity outside of Qatar to offset 20% of the global market. Unlike the oil market, which has OPEC plus, they have some spare capacity, they can ramp it back up. The gas market doesn't work like that. Since Russia's invasion of Ukraine, they shut down pipeline gas supplies to Europe. The gas market, the LNG market specifically, has been running all out. So every facility that exports LNG essentially has been running at full capacity. There are some caveats, but that's basically where it is. Where are people going to be fighting for LNG? It's going to be American LNG. In fact, what's pretty funny about all of this is that U.S. LNG might be the big winner. The U.S. is really the only country right now that's meaningfully ramping up its output by building new facilities. And it is flexible supply, which means where the U.S. is located, the LNG can go to Europe or it can go to Asia. And so if there's a price war, suddenly people are bidding up that American LNG, and the winner ultimately are American LNG exporters. So it's, you take a step back and you look at the situation which the United States caused in the region. One of the big benefactors is American LNG producers, and they're one of the biggest segments of the economy.
Stephen, it's great to have you. Stephen Sepchinsky, they're the perfect guy to talk about what impact we're seeing across these LNG markets here this morning. Take a look when it comes to your Greater China agenda, what to watch here today. Obviously, we're still watching this kind of onshore market. We just had Goldman Sachs' Tim Mo saying this might be the place to be to really kind of shield yourself from all the volatility that we're seeing externally here. Obviously, we've been seeing what happened with HS Tech, continue to see that sort of down drift there at that 5,000 level. We talked about the correction that we saw when it comes to H shares yesterday, that 10% drop from October 2nd level. So certainly that's one thing to watch. Southbound net flows is interesting. We did actually see mainland buyers come through and buy on the dip here. So that could be a telling signal there, but maybe we could be seeing a bit more of that change. CNY as well, quite a bit of weakening in the currency, right? We're actually back up to 690 levels. We'll see what the fix brings us here. But yes, there also is that CPPCC briefing. Let's not forget what's happening in Beijing, too.
We do have, in fact, that fix right now coming up. It's 69088 against the U.S. dollar. So it is a 690 handle as far as the fix is concerned. We'll see what CNY and, of course, onshore trades in about 15 minutes or so. Just on some sectors we're tracking, defense for very obvious reasons, chips following the sell-off yesterday, energy and materials. Given the continued upward pressure we're seeing, that I'll even include precious metals, right, given where gold is currently. A couple of stocks to watch, Xiaomi on the downgrades, Baba being added to the Goldman conviction list, and also Minimax, given, of course, that revenue guidance coming out of the company. Minimax and friends meaning, of course, peers in the industry.
Yeah, we'll see a big move in the stock, just given the numbers have come out, which are quite substantial here as well. Coming up, though, we're going to speak with CSIS Director Mona Yacoubian, joining us to explain why the strikes on Iran may prove to be a costly gamble by the U.S. Futures are pointing slightly to the upside here today. We're up about 0.5%. This is the China Show.
We would love for there to be an Iran that's not governed by radical Shia clerics. We would love to see this regime be replaced. The objective of this mission is to make sure they don't have these weapons that can threaten us and our allies in the region. That's why we're doing what we're doing now. And while we would love to see a new regime, the bottom line is no matter who governs that country a year from now, they're not going to have these ballistic missiles and they're not going to have these drones to threaten us.
U.S. Secretary of State Marco Rubio there outlining the administration's reasons for attacking Iran. Joining us now from Maryland, let's bring in Mona Yacoubian, Director and Senior Advisor of the Middle East Program at the CSIS. Mona, it's great to have you on the program. You just heard from Marco Rubio there on really what the rationale was for the U.S. and Israel to strike Iran. Does that seem justified in your eyes?
I think there's still a very disturbing lack of clarity as to the rationale. I mean, we've heard numerous reasons raised, from Iran's nuclear and ballistic missile capabilities to addressing the leadership in Iran, etc. None of it really seems to make sense in terms of available intelligence reporting, none of which points to an imminent threat. And therefore, this really looks more to have been a war of choice rather than a war of necessity. And we are seeing play out now, just entering the fourth day of this conflict, the multiple downside risks, from energy market hits to U.S. soldiers being killed in combat, to security risks in American embassies being targeted, to multiple countries now becoming embroiled in this conflict. We are truly watching a region-wide conflagration unfold before our eyes.
So, Mona, among the many risks, what do you think is most pertinent at the moment? If I know that's almost an impossible question to isolate that, but where do I need to be looking?
Well, I think the energy markets are in particular significant, given this part of the world's crucial role in both oil and gas markets. And your analyst that was on before me was laying down these historic jumps in gas prices. I think the problem is we don't know the duration of this conflict, obviously. And frankly, it's very hard to imagine that this is going to be a replay of the 12-day war that we saw this past June. This is far more complex. It involves far many more countries. And of course, with the assassination of the supreme leader and questions about who's even in charge in Iran and what's Iran's risk tolerance, I would argue Iran's risk tolerance is very high because they are facing existential threats. And so if we are watching something that could last for weeks and maybe even months, that is going to have enormous reverberations across global energy and shipping markets. And of course, we also have to look at lives that are at risk across the region.
I mean, Mona, I want to pick up on that. This now involves many other parties. Might be a dumb question. I don't know. I don't have the answer. Why is Iran bombing its neighbors? So I get why they would target places with U.S. bases, but Dubai, for example, and how does that then affect those regional powers in their response to Iran?
I mean, I think there are two ways to look at it. You're absolutely right, David. I mean, on the face of it, they've managed to galvanize these Gulf countries, frankly, against Iran. Iran is now completely alone. These were countries that were advocating against conflict with Iran. And so, in a way, it does look sort of foolhardy and hard to understand. On the other hand, if for Iran the stakes are existential, then at this point, I think they are making a gamble that they are going to race up the escalation ladder and impose higher costs and sort of, in a way, invite a prolonged conflict. And that's exactly what they're doing, perhaps with the calculation that ultimately, especially these energy-producing Gulf countries, are going to really push hard on the United States to find an off-ramp to de-escalate this conflict because of the disruption that it is causing. So in a way, Iran is taking a sort of an asymmetric approach to this.
We've been talking a lot about the risk of a more wider regional war. I'm just wondering in terms of the Iran proxies, right? The Houthis, the Hezbollahs. Does Iran can they maintain control of some of these groups here right now? Or is there actually a chance that they could actually mobilize?
Well, it's really interesting, Yvonne. I mean, we just saw in the last 24 hours, among the different types of escalation that we've witnessed, is the more intensive use of Iran's proxies. We see this most notably in Lebanon, where Hezbollah, which frankly is under greater Iranian influence than it's ever been, undertook rocket attacks against Israel, quite frankly, relatively weak rocket attacks. They didn't cause any damage. But this has now brought an onslaught, an offensive by Israel against Lebanon. And so we'll have to see how that evolves. I think the key proxy that has yet to really raise its head again are the Houthis. And that will be significant if the Houthis choose to get involved. Should they seek to restart attacks on shipping in the Red Sea, to snarl the Bab el-Mandeb, another critical choke point in the area, then I think we could see the disruptions that we're already watching unfold grow exponentially. And this could have an enormous impact, not only on the region, but globally.
Mona, just quickly, if you could, where does this leave the nuclear assets or the ability to specify the ability of Iran to enrich to a certain level? And do we circle back to a negotiating table at some point here on those?
Well, David, I mean, there were already questions as to whether or not Iran had started to move back toward restarting its nuclear program. The program, the facilities, certainly sustained significant damage in the U.S. and Israeli strikes this past summer. And so there was no suggestion that Iran's ability to begin enriching uranium again was imminent. Perhaps they were looking to restart or start to repair those facilities. As some of the imagery is showing, the U.S. has gone back and hit some of these sites, again, the U.S. and Israel, I should say. And so I think Iran's nuclear capabilities remain, dramatically curtailed.
Mona, we got to leave it there. Mona Yacoubian there, Director and Senior Advisor of the Middle East Program at CSIS. Particularly your pre-market here right now, and we are seeing a little upside when it comes to Hong Kong markets here today. Keep in mind, we're watching Minimax there after we talked about their results. Disclosing really token demand that has grown rapidly according to JP Morgan. There you go, shares up 10%.
We think that there are a lot of A-share specific benefits right now. Some of the modeling that we've done shows that the exposure that the A-shares give from a kind of a sector weighting basis to the themes that are likely to be emphasized in the 15th five-year plan, which really lean into advanced manufacturing, higher technology, and sort of China's efforts to build its market share externally. A-shares have a lot of exposure to that in the current context, and the fact that it's less correlated to what's going on in terms of global macro and the risk-off environment that we're seeing, that the attraction of A-shares right now actually even stands out further.
Yeah, Timo, they're underscoring the recent price action, and hence why we're probably going to see these markets open higher today.
Yeah, so it seems like markets in some ways are pricing in that maybe this conflict in Iran might last too long, right? Just given what we've been seeing with the equity markets, there is already seeing maybe a bit of dip buying if you see how southbound flows have been acting yesterday already. So that does lead to a better backdrop, at least here today, where you are seeing onshore markets. Still that bright spot here yesterday also, China actually did better than the rest of the region. So is China still that sort of diversification play? We are seeing upside about 1/5 of 1% here for CSI 300, Shanghai Comp just trading around that 4,200 level as well. Keep in mind, though, it has been sort of this, selling of bonds, right? This route that we've seen in treasuries and late, that there is now a sense of an inflationary scare that could come out, given the disruptions that we're seeing with energy infrastructure in the Middle East, what we're seeing with LNG prices that surged double digits yesterday in Europe. So certainly that is one thing to contend with across these markets. But look at that Shanghai crude now opening up there. We're seeing 12% gains once again with Shanghai futures here this morning. So we're tracking still the energy space, not just gas prices, but oil continues to be quite elevated here this morning. Keep in mind, though, we're still watching some of these sort of tech names as well. Capricorn is slightly down. CATL, meanwhile, is actually doing quite well. We're up some 2% right now for the lithium supplier and the like there, the battery maker, the like. So take a look when it comes to Hong Kong. Interestingly enough, we are seeing a bit of a rebound there. Maybe the southbound flows, we might see another day of net buying here. HS Tech seems to be catching a bit here this morning. We're up about 0.7%. Hang Seng around that 26,000 level, but it really was the H-share market, right, where you did see the HSCEI now enter technically into a correction yesterday. So we are seeing a little bit of more upside here, a bit across H-shares here this morning. We're up about 0.5%. Property is once again reigniting that rally here once again. We're watching the tech space very closely. And given what we've seen, right, obviously we're focusing on the likes of Minimax here today, but stellar numbers that came through in their results. So, JP Morgan was talking about token demand. So we'll see how the rest of that is looking. But you're looking at Xiaomi as well. JP Morgan coming through and trimming that price target to $35 here. And they're talking about the surging price of memory is really going to cut into their margins here. We take a look at the smartphone business and really the EV competition that continues to look hot. But Alibaba still looking pretty good here, standing out amongst the tech crowd there. We're up about 1.4% there today. Let's take a look at when it comes to gas stocks, crude stocks. That certainly has been something that continues to move up to the upside here, just given what we saw with gas prices that surged. We'll also talk about chip stocks, right? So the whole Nvidia sort of aspect here. Sources telling us that the U.S. may be considering putting caps, really, on the H200 sales at $75,000 per Chinese buyer. That seems to be benefiting potentially some of the national sort of chip makers out there, like SMIC and Hua Hong Semi. They're both up some 1%. ASMPT, meanwhile, is up close to 6%. And then there is this whole story about Nvidia investing $2 billion in these data centers for optical networking, right? So we're talking about Luminax, some of these companies here. So we're watching these optical sort of stocks in China. There you go. They are also heading higher here this morning. And we talked about Minimax. So they more than doubled when it comes to their sales. JP Morgan was talking about token demand is growing more rapidly than expected there. So there you go. We're up 5% for Minimax. Jupu, I should say, also heading higher along with it, Dave.
Yeah, same names, right? So you have the AI and chip plays, and you have, of course, the upstream energy producers. So Yvonne just went through some of the explorers listed here in Hong Kong. You have, of course, a lot of the big ones listed onshore. I mean, hence Shanghai Comp, 2015 highs, right? On that benchmark, PetroChina and Sinopec are leading that chart, and that really dovetails into the broader Middle East story with oil prices where they are. Shanghai crude up 10%. It's now become an inflation issue. Is that a risk that we should entertain even further moving forward? Joining us now to talk us through all these big and macro themes, given what's going on, is Arthur Budaghyan, Chief EM Strategist at PCA Research. Arthur, good morning from Hong Kong. Thank you for joining us, sir. I was wondering if you could start off with this latest inflation scare, given energy prices, shipping costs, and that massive pop that we've seen over the weekend. Do I need to be worried about that?
Not really. I wouldn't be worried about energy shock translating into inflation. In fact, if anything, high energy prices might be restraining global demand, global consumer spending, and war action in Middle East might depressing business sentiment. I would be worried about kind of a weaker growth and subsequent disinflation, not inflation right now.
Okay. That's why you're saying you're still anticipating some sort of global disinflationary shock and saying that bonds are a buy. Where to really is the place to really park your money in bonds now in fixed income?
Yeah, I think for next, let's say 9 months or so for remainder of this year, we have to understand what will be the key driver of a global macro dynamics. In my opinion, beyond near term, over next 9 months or so, the key driver will be dollar. I think US dollar will be falling because less capital will be flowing into US. And dollar will be mechanism to force a narrowing of U.S. current account deficit, which means shrinking U.S. imports. And shrinking U.S. imports are going to depress global manufacturing and global exports, which is disinflationary for the rest of the world. So I recommend buying bonds in Japan, in Europe, in many emerging market economies that are leveraged to global trade, and they will be hit kind of negatively. Plus, the currencies will be appreciating meaningfully. So being long domestic bonds in select EM, in Japan, in Korea, in Europe, I think the best risk-reward going forward.
Arthur, what about gold? And gold in the context of disinflation or really any other reason why gold is going up?
We have been bullish on the gold for past 6 years or so, but the exponential increase in the gold prices over past 6 months make it quite overbought and vulnerable to correction, especially that gold purchases have not been driven by central banks in the past 6 months. It has been mainly driven by retail or portfolio investors around the world, including in Asia. So when retail investors chasing kind of asset market, I'm a bit cautious because they can turn and sell on as fast as they've been buying. So I believe gold, silver, copper are witnessing very overbought conditions, and they're going to correct over the next several months. So over long term, I would be bullish gold. I'm bullish gold. I would be buying gold when it comes, let's say, below 4,500, 4,300. But at this point, I won't be chasing gold higher from this point, despite what's happening geopolitically in Middle East.
That's interesting, yeah, because that's your buying level on gold is about $1,000 below the current levels. Arthur, we don't often talk about God on this program, but talk to us about God here. Get out of the dollar, to your point, the other side to the gold story. And what do I buy?
So my key thesis over past year has been get out of the dollar. I think dollar have made a major top a year ago, and dollar has fallen and somewhat oversold too. It might rebound in near term given what's happening with oil prices, risk off. But over next 12 months or so, I believe US dollar will depreciate substantially versus Asian currencies, versus European currencies, and some other emerging market currencies. So dollar depreciation, as I said, it's a deflationary or disinflationary for rest of the world because dollar will be depreciating not because US interest rate will be lower or falling relative rest of the world, but US is running unsustainable current account deficit, funded it by speculative portfolio inflow, buying US stocks nowadays. In my opinion, it's a speculative portfolio flow. And I think that portfolio flow is going to decline, not reverse, just it will be flowing into US at slow pace, and less inflows are going to force dollar down to correct current account balance, because ultimately capital account should be equal current account. So I think dollar will be weaker, and buying bonds in the rest of the world is the best investment bet for next 9 to 12 months.
It's interesting you said instead of, buying the dollar, let's buy the yen instead. You have a very interesting note that says the yen carry trade is a ticking time bomb. Can you explain that a little bit, Arthur?
Yes. A couple of weeks ago, we at BCA Research published a report on yen carry trade. We took a very comprehensive view how big yen carry trade is, what is driving it, and how it can unwind. And conclusion was it's massive, yen carry trade massive. And don't look at Japanese interest rate rising to unwind yen carry trade. In fact, last 3 occasions when yen carry trade unwound, it was due to global risk assets selling off. So if global risk assets start selling off, which is my baseline view, a yen carry trade will start unwinding, and it will reinforce downside in global risk assets. And in the process of yen carry trade unwinding, Japanese yen is going to rally substantially versus US dollar. So I believe yen has made a bottom. It might still go kind of sideways in near term, but if I have a, let's say, 9 months outlook, I would be buying Japanese yen at this point, and Japanese bond yields too, because as Japanese yen rallies a lot, it will be introducing disinflationary pressures into Japan, and Japanese bond yields will fall.
Arthur, we're going to leave it there, but thank you so much for bringing your views there. Arthur Budaghyan, their chief EM strategist at BCA Research, joining us from Montreal. Thanks for staying up. Well, coming up, China's foreign minister calls on Iran to think of its neighbors when responding to the U.S. and Israeli strikes. We'll have the details coming up next. This is Bloomberg.
Right. Let's have a closer look at the China angle to what's going on in the Middle East. You have the foreign minister, Wang Yi, calling on Iran to pay attention to the reasonable concerns of its neighbors as Tehran retaliates against U.S. and Israeli attacks with their strikes on other Gulf nations. Let's bring in Min Min Lo in Beijing for us, a China correspondent, to take us through this. Min Min, so what does this tell us? Does this tell us anything more, specifically where Beijing stands in this conflict?
Well, I think it tells us that Beijing is taking a very pragmatic stance here, because we have the foreign minister making a call to his Iranian counterpart yesterday. And yes, he repeated the lines about how China is calling for a ceasefire, how China is standing by Iran in safeguarding its sovereignty and territorial integrity. But he also said, pay attention to the legitimate concerns of your neighbors. And this shows you that China is concerned about stability in the broader region, because if you think about China's trade and investment flows, its ties with countries like the UAE, like Saudi Arabia, Qatar, for example, and all of these other Gulf countries far outweighs its ties with Iran alone. And that's why the Chinese foreign minister also said, pay attention to those concerns from neighboring countries and also safeguard the safety of Chinese citizens and Chinese institutions in Iran. Interestingly, we have the Securities Times, a Chinese state media, putting out an article saying that of the small numbers of A-listed companies in Iran, most of them have very limited risks there because they do have diversified global deployment. And the paper is saying that this disclosure is important to stabilize market sentiment at this time.
Yeah, and there was a lot of speculation that China might be giving some sort of military sort of support to Iran. I mean, are there signs really that Beijing might directly supply Iran with arms?
The short answer is no. China has not officially sold arms to Iran since 2005, since the IAEA found that Iran has violated the non-nuclear proliferation treaty. But yes, there has been reports, Reuters, for example, saying that China was close to sealing a deal with Iran to sell anti-ship missiles. But this was something that the Chinese Foreign Ministry has denied. And so far in the battlefield, there has been no evidence of Chinese weapons being used, although the sale of dual-use items often provides a cover for China, right, in the same way it does in its relationship with Russia when it comes to the Ukraine war as well. So we see China sort of also shifting the attention here to the U.S. with the People's Daily yesterday publishing a very scathing editorial targeted at the U.S., saying that the U.S. attacking Iran at this time during a time of negotiation really is setting a new precedent and is very harmful, eroding trust there because it is using force as leverage, as an ultimatum, rather than using the negotiation to actually build consensus. So we see China sort of moving in here to once again portray itself as an alternative sort of power that is upholding international norms here. But it's worth noting that so far China's support of Iran has remained largely rhetorical.
All right, Min Min, thank you. Our China correspondent Min Min Lo joining us there from Beijing. Bloomberg Economics has also been saying that the impact on China's economy from the war in Iran looks manageable at this point, but with a potential mild boost to inflation from a rise in oil prices. But really what they're talking about now is the hit from geopolitics that might be greater. Here to join us more is our chief Asia economist, Chang Shu, joining us here in the studio. So what do you mean by that the geopolitics is bigger?
Yeah, so it's far more complicated. If we just purely look at the economic calculus, China will be impacted negatively, given that China is the biggest importer of oil in the world, and a large part of the imported oil come from the Middle East. So we can see in the mild case of the conflict not lasting very long, inflation may be pushed up just by 0.2% or so. Even in an extreme case, it could be, inflation going up by 0.8%. But if we look at the geopolitical context, the calculation is much more complicated. Domestically, we know last year the trade sort of battles or war, whatever you call it, between China and the U.S., it's largely perceived by China as a win. So that helped build up the confidence within the country, and the sort of the narrative for East rising and West falling type of narrative was strengthening. But this time, yes, and China has taken a pragmatic approach. China can cast the U.S. as the instability factor. But then, on the other hand, it does show China has limitations in shaping what's happening. So to that extent, that really shows a very stark asymmetry between China's increasing economic cloud and its constraints in projecting influence in many other areas.
You coin it as China's low to no profile in these events, right? And you mentioned perception, that's important in this case. Why is that a real issue here?
Yes, in this case, in China, it has very limited ability to affect what's happening on the ground now. And if you link this together with what happened in January when the U.S. seized the former Venezuela president, so it's, in both cases, those countries are supposed to be China's strategic partners, and China really faces practical limits to influence what's happening. So that perception could dent the sort of confidence built up over the past year or so within the country, and on the global stage that might sort of kind of make people or make countries sort of reassess the sort of partnership with China. So it's complicated. I think China rightly has been taking a pragmatic approach, but in terms of sort of perception and power play context, the calculation is quite complicated.
Yeah, and a bit more cautious, as you say. It gives you, maybe they are very focused on what happens domestically. I mean, with NBC coming this week, I'm sure they would like to focus more on the economy. What should we be looking at the most at the end of this week?
Yes, the two most important agenda items. First, the budget on the first day, on Thursday. And secondly, the 5-year plan, the new 5-year plan will be discussed and approved. In terms of the specific things we are looking for coming out, I would say the single most important thing is the growth goal. We know China in the last couple of years set the goal at 5%. And this year, the pressures are quite strong for coming from provincial governments' goals for the central government to lower the national one. And over half of provinces representing over half of GDP have lowered their goals. So on the one hand, there's sort of pressure for national government to cut it. On the other hand, sort of you can think, this is the first year of a new 5-year plan, we shouldn't. So we see potentially two ways to soften the targets. One is to still set 5, but use some sort of softer language to indicate this is on a best effort basis, and maybe some sort of undershoot is possible. So that's possibility number one. Possibility number two is a range, so 44.5 to 5% or so. So and obviously we need to watch out the consumption, to what extent China would commit this sort of to consumption to GDP ratio, whether they give a specific figure.
Changshu, thank you. Fantastic. There we go. Lots to look forward to this week. You almost forget, given what's taking place in the Middle East, that there is this massive domestic economic exercise taking place in Beijing. We'll continue the conversation around China. Of course, the NPC, CPPCC, by the way, begins, I believe, today here with a look at the economic priorities. There we go. Arthur Kroeber joins us at those times on your screens. Plenty more ahead. Right. Just before we get into the second hour, just a look, importantly, of course, the reopen in Korea. And within that, we're looking at the defense-related names. Hanwha Systems, of course, very much tied tangibly to what's taking place in Europe. And, of course, the opposite is happening across some of these Chinese names. Plenty more ahead. This is The China Show.
Welcome back to the China Show. A look outside of Hong Kong here today. And yeah, we continue to see a little bit of a moderate declines here when it comes to the Hang Seng. We've bounced off some of the session lows, sort of, if you take a look at that chart there. But yes, HSCEI is certainly the one to watch here, given that it did enter that technical correction yesterday. We actually have been seeing a bit of a reversal in some of the Hong Kong sort of benchmarks here. HS Tech now in negative territory. We're down about 0.6% there, Dave.
Yeah. So we are extending after entering a technical correction. And I imagine also when you look at the Hang Seng Tech Index, underperforming still, 0.7% coming up. So that is sinking deeper into bear market terrain. As we flip the page, just bear with me. I'm looking at southbound flows to get an indication if we're getting day 3 of dip buying into this market. Just bear with me for a moment there. But yeah, as things stand, we're down 0.7% just about across the board, including, by the way, Shanghai Comp and CSI 300, which were the standouts yesterday, also giving up some of the gains there. We are now looking at negative flows, by the way, across the Stock Connect, just to close that loop. Japan, Korea is coming back online. You have Taiwan. Within Japan, of course, there's the sort of cable, literally the wire maker story on the Nvidia story. We'll talk more about that in a moment. It's broad risk aversion, as you can see. The dollar is continuing, I believe, its strength coming through, although the PBOC came out and with a dollar weakness, actually, on the back of stronger fixing, strengthening the fix by the most since August. There we go. That's the operative word. Aussie assets are in focus because this inflation stories showed up in markets with bond yields just about across the world picking up. And in Australia, specifically, there's some commentary coming through out of the central bank. They're talking about how they do have the options in case they need to act more firmly against inflation. So as you can see, we're up double digits in basis points, as you can see on the 2- and 5-year yield there.
Yeah, it's interesting. We've had some commentary from the likes of, Howard Marks saying that don't let your emotions cloud the judgment on the war here. We just, you don't really know how long these disruptions will last. I think that's the biggest question among traders here this morning. And so really, it's easy to use your emotions to kind of trade, but you're not really sure what the outcome is going to be, according to Oaktree there. So certainly that's going to be one thing, right? So don't let your emotions affect you. That's not going to be helpful. And then you have the likes of Jamie Dimon, though, saying, look, there might be some sort of these inflationary scares that you're seeing and inflation expectations in the bond markets here right now might actually be something that you need to really concerned with, right? He talks about inflation might be that sort of skunk in the party for the U.S. economy that could emerge out of this whole thing. Yeah,
unless it's a bad-smelling party, of course. The skunk would be the feature, not the bug. I mean, to the point Yvonne was making, right? So break-even rates, break-even yields picked up the highest. I think it was the second biggest jump, with the exception of October last year, in the 2-year break-even. The next full rate cut that's being priced in markets has been pushed back by a meeting from July last week to September as I speak. And a lot of that comes down to the oil story, right? When you have energy prices at their levels currently coming up on your screens, it's now become just more than the oil story. It's now become a gas story, too, as you can see there, 1.3% to the upside. Right. Now, we've also heard from Saudi Arabia's Prince Turki Al Faisal here calling the attack on Aramco facilities an act of provocation coming through from the Iranians.
This obviously is a provocative step on the part of the leadership in Iran to try to elicit a response from the kingdom that would then be responded to by them, and it will widen the conflict not just between the kingdom and Iran, but also between the whole area and Iran.
And just in the latest here, we've heard, there were some kind of shelter-in-place sort of alerts that are happening in the U.S. Embassy in Riyadh just this morning as well. There's also been some mixed messages around the timeline of all this, right? The U.S. says the Iran war will not be endless, but D.C., we're hearing a lot of views about just that timeline. Let's bring in Jill Deesis, our news desk managing editor, on really how long they think this disruption can last.
I mean, Yvonne, when you talk about those conflicting messages out of the U.S., I mean, really, you've got the Defense Secretary, Pete Hegseth, saying that it's not an endless war, but you've got Donald Trump, honestly, in some cases, conflicting with himself, depending on, what time of day you really catch him at. I mean, he said anything from, this could last 4 to 5 weeks, the bombardment campaign, to, well, we've got the capacity to carry on for much longer than that. It's really, really difficult to say when it comes to exactly how long this could ultimately go, but what we're looking at right now is a very much a live situation. As you just mentioned, Yvonne, you've got, just recently, this campaign. It seems Iran is ratcheting things up against Saudi Arabia, or the U.S. embassy there. So lots of action, lots of movement still actually happening here, but really unclear exactly how long this may end up going.
Do we know more about the latest? I mean, you mentioned, of course, the embassy that we're trying to figure out as well. What is the latest in as far as the conflict is concerned? We're trying to figure out why markets are selling off, in fact, as we speak here.
Yeah, I mean, I think at this point, David, we're trying to get a little bit more clarity there. Yes. Again, we just have that very basic information about these hits on the U.S. embassy in Riyadh. So obviously still investigating exactly what's going on there. We're talking with our teams on the ground to get more clarity. So, I'm sure more to come on that front. But again, as we can see, just a ton that's actually developing here. You've got the United States telling, Americans, U.S. civilians all across the Middle East to get out. There's unconfirmed of some, explosions elsewhere. But again, I think we have to be really careful with exactly how we sort of, describe this kind of stuff. So really, really zooming in right now on what's happening in Riyadh. But, hopefully, getting some more clarity there. I'm fairly certain. I think the other thing to really look out for here is Bibi Netanyahu is speaking on Fox News, I think momentarily. So may have some, more insight there on sort of the Israeli perspective and their involvement in this campaign. But again, as we've been discussing, obviously a lot of very quick moving developments here.
Well, what do we know about the Qataris asking U.S. allies in the background here? Oh, yeah. What's the ask, and is there any progress there?
Yeah. So at this point, you've got Qatar as well as the UAE trying to find those allies and kind of consolidate this idea of ending this conflict at some point fairly soon. So the entire aim of those kinds of talks is to ultimately get some kind of a coalition there that can push the U.S. to end this conflict sooner rather than later. Of course, though, as we've been talking, you've got Trump, running around on Monday saying that they've got the capacity to extend this campaign for beyond that 4 to 5 week window that he originally was talking about at the beginning of this week. So again, it's unclear how successful that may ultimately be, but there certainly are, some of those attempts to try to mitigate this and contain the conflict to as small a window as possible.
Jill, thank you so much for getting us up to speed there with the latest. As we were just having that conversation, risk assets are taking a further leg lower. We're down 3% now in the Kospi. CSI 300 in mainland China is now down about 1%. We're looking at the energy space specifically, too, here on the back of multiple fronts of whether freight rates are going up, shipping costs. You're looking at several asks being negotiated as well. There's an insurance component here as well. I think one of the things is benchmark tanker rates for hauling things like gasoline, diesel from the Persian Gulf to Japan have surged more than 36% as the ships steer clear of the Strait of Hormuz here. The TC5 long-range route here jumped above the 308 world scale points on Monday. That's the highest in nearly 2 years here. In time, the charter terms daily rates climbed to about $56,000, the highest here since May of 2024.
And we are watching stocks of Costco shipping after the company said it was evaluating plans for cargo movement in the Middle East. An advisory says vessels in the Gulf have been asked to proceed to safe waters and that ships destined for the region are asked to prioritize navigational safety. The company is also considering contingency plans for cargo abroad affected vessels.
Okay. Joining us now to discuss how the commodities sector has been coping with these disruptions in the Strait of Hormuz is Anton Posner, CEO at U.S.-based logistics and consulting firm, the Mercury Group. He joins us out of Florida today. Anton, good morning from the Asia Pacific. Let me just get straight to it. What are you hearing from the folks on the ground about what's going on? What's being disrupted the most from your perch?
Sure. At the moment, we're seeing basically the world waking up today in the U.S. side to trying to figure out exactly what's happening in the Gulf, what's happening with ships that are currently loading or discharging in the Persian Gulf, and what's going to be coming up potentially out of the Houthis and potentially for a restart in their attacks in the Red Sea and affecting the Suez Canal. We're seeing the insurance giants putting out notices of canceling more risk policies that cover ships entering the area, and of course, this is having an effect across the board on freight, as you mentioned. What you're seeing and what everyone's seeing in the energy markets is also affecting my world, which is more of the dry bulk, critical resources, mining, and metals sectors.
Right.
Mm-hmm.
So what do you see the most disruptions then? Do you think it's going to be cargo flows? Do you think, I mean, it seems like right now when it comes to vessel diversions, people are kind of heading through, the Cape of Good Hope here this morning. How are you seeing all this kind of diversions and how this is all being mapped out now?
Right. And there's no one answer to that situation, but to give you some examples of what we're seeing. So on our ocean freight teams dealing with one ship loading dry bulk cargo in the Persian Gulf and Saudi port. At the moment, the ship continues to load at the moment, but whether or not she will actually sail and depart the Persian Gulf and when is a question mark. What the safety situation is going to be. You have Iran's Revolutionary Guard saying that they're going to set ships on fire that try to transit the Strait of Hormuz. So that's not exactly the ideal navigational situation, to say the least. Right? You have ships that were supposed to be moving into the Persian Gulf, say with inbound grains or to load outbound fertilizer cargoes, that are just turning around or dropping anchor or going to other ports now and not going in to discharge their grain cargoes or load their outbound shipments of aluminum or outbound shipments of fertilizers, right? Again, talking about the dry bulk world, which is my world. And so we were talking about a significant disruption here at this point. When our team is talking to ship owners about what their decisions are and what their thinking is for upcoming contracted cargoes. These are shipments that are already under contract for a specific time, let's say later in March. Right now, there's a question mark, right? What's going to happen? Is it going to be safe to transit? Can they perform? Can these ship owners perform on these voyages? Can they get insurance coverage to cover those? Are the ship owners going to declare and implement a clause in the contract of carriage, the charter party, to get out of the shipment due to war? Is this a war? Is it a declared war? Right? Is it a war as far as legalities are concerned in relation to potential maritime law and maritime arbitration? Right.
Anton, I'm glad you brought it up because. Certainly a lot of people are scrambling for clarity around. It might sound trivial at this point, given everything else that's going on. But how does the insurance sector come in here? In what sense? And I mean, there's a reason why a lot of the exceptions are, acts of God and acts of war, for example. Where is that conversation now?
Sure, and I'm certainly not an insurance expert, so take it for what it's worth, right? But in this case, you're talking about Lloyd's getting the war risk team at Lloyd's getting together. The major marine insurance firms put out a notice yesterday declaring that the war risk coverage on their policies for ships are going to be withdrawn as of March 5th. So that's a major setback in terms of being able to sail comfortably through this essentially war zone, for lack of a better term at this point. That means that, this was also precipitated by the reinsurance firms, that the underlying reinsurance withdrawing their coverage, right, to the major insurance carriers. So these ship owners now need to go out and get new coverage for their ships to transit through these areas, in high-risk areas, of course, right? So that they have coverage in case the ships are attacked, sank, burned, whatever at this point. So you're talking about significant cost jumps. The ship owners will then be passing along those higher insurance costs, of course, to the shippers, the charterers of these ships, the cargo interests.
How are we seeing, just when it comes to tanker rates this morning, freight rates and the like? I mean, I know we've seen a bit of a spike. Is there going to be a chance that maybe we could see even more higher sort of spikes in prices moving forward?
Sure. And yeah, tanker freight, while not my area of expertise, I think at this point there's a clear sign that this could get significantly worse, right? If the Iranian government and the Iranian Revolutionary Guard is successful in attacking and damaging, potentially sinking more vessels in the Strait of Hormuz, and there's a complete shutdown. I think, as we've all seen, everyone at this point over the past 24 hours has become familiar with the fact that 20 to 30% of the world's petroleum and gas flows through that Strait of Hormuz, right? So if there is a shutdown there, we're going to see ships caught behind the shutdown and a significant freight rates on tankers on the tanker freight market across the board globally as ships are pulled out of the market, and that there's more urgent cargoes that need to move from other parts of the world to satisfy demands that are not going to be able to be met coming out of the Gulf.
Yeah, Anton, we're trying to figure out what the big picture is, whether or not there is an effective, not official closure there, and we're piecing this together through conversations like this. What are you hearing from your contacts in terms of disruptions to either port activity on the other side, so we're talking about the Persian Gulf, or the Gulf of Oman? Any insights you could share as far as disruptions there?
Yeah, there have been some delays. So ships loading and discharging currently at Persian Gulf ports, there have been some delays, port operational delays. Not seeing on the ships, at least that are within our team's control, not seeing complete shutdowns or abandoning of cargo operations. So ports are operating certainly cautiously. Labor potentially not showing up in some instances at this point, but it's still too early to tell. But not seeing complete port shutdowns at this point. Ships are loading, ships are discharging. It's whether or not ships are going to be able to transit out of the Gulf after they've completed loading or discharging. On the Gulf of Oman, on the other side, at this point, have not seen any significant impacts, but this is going to be watched carefully. Of course, that starts getting closer to the area where the Houthis have threatened to restart their campaign of attacking ships going through the Red Sea, the Suez Canal, and so forth. So there's certainly a significant threat to the entire
Anton,
region at this point.
Yeah, Anton, I'm sure it's keeping you busy. Thank you so much for giving us a bit more insight on what's happening in the world of shipping and logistics. Anton Posner there, CEO at the Mercury Group, joining us from Sarasota, Florida this evening. We are just getting those lines, as Jill mentioned earlier here, of that interview with the Israeli Prime Minister Benjamin Netanyahu, speaking to Fox News in just the last couple of minutes, and really kind of reiterating what we've heard from the U.S. in terms of Pete Hegseth and what he has talked about, the timing of this war. He says not going to have a, quote, endless war. And Netanyahu also saying Iran war is going to be quick and decisive action. That's the latest that's coming through so far. But yes, still a lot of questions on really how this war is going to end. But yes, it seems like, at least from Israel's side of things, they're hoping this could be ending pretty soon.
Right. Just ahead here on shows, obviously this is going to be part of the conversation remaining too. One of the other things that's taking place as well, it's actually showing up in small parts of this market is number one, the Nvidia story, but not the chip story in China, but there's a separate Nvidia story. Anyway, we'll unpack, of course, the reported limits that officials are said to be mulling in terms of capping the number of accelerators the company can sell to one single Chinese company. The details in that scoop just ahead. Right, welcome back. You're watching The China Show. We're looking at, and as you can see on your screen, some hefty declines we're seeing across these names here. Chip-linked stocks here. That's after Bloomberg revealed that Nvidia could be restricting H200 accelerator sales to mainland China. This would also curtail, of course, the U.S. tech giant's efforts to re-enter the market, which I believe, based on the latest financial reports coming out of Nvidia, the assumption is still no China business. Let's bring in Belle, here with us on set, to talk us through what we know about this.
Yeah, it's a little curious, actually, I find, the reaction today, because this Bloomberg scoop that we have, that essentially they could be capped on how many sales they can do of H200 chip sales to each Chinese company, is actually more of a benefit to these Chinese names, because we were reporting at the end of last year, when H200 sales were first greenlit by the Trump administration, that names like Alibaba and ByteDance, for instance, would have wanted to buy around 200,000 chips apiece. So 75,000 is well under that mark. And just to be clear as well, it's 75,000 total per company. So that also includes either business in China is looking at AMD's equivalent AI processor, for instance. They can only have 75,000 total. So it's Nvidia plus AMD in this.
Oh, okay.
Yeah, and maybe they're just getting swept down in this whole kind of Iran situation. Maybe not because of the story as well. I mean, how likely do you think this is going to factor into Trump's planned visit to China?
Yeah, we've had some also part of this scoop that we had from our team earlier today. It is likely to be an agenda item or a key agenda item for Trump when he does, if he does, of course, visit at the end of this month and kick off those meetings with President Xi in April. But the focus that he wants essentially is to maybe announce some deals around this. But of course, the key question still comes back to China's plans, and we still don't really have that guidance if Beijing is also going to be allowing its companies to purchase H200 chips, given they also need to balance against their own sovereign build-out versus, of course, buying this technology from the States.
Bill, just before we get into the Minimax earnings, I just want to mention to our viewers here, you might have already seen it. The MSCI Asia Pacific is selling off, and it is picking up to the downside here, 2%. Now set for the biggest single-day drop in about a month or so, with the Korean markets, of course, coming back online, leading that to the downside. We'll get more on this, of course, later on in a couple of minutes. But, Bill, talk us through Minimax earnings here and the guidance
so
there.
This is the first earnings we've actually had from Minimax since they listed at the beginning of the year. So good numbers overall. We saw a very strong jump in revenue in 2025, so around 160%. So that came in at $79 million. That was well ahead of what analysts were thinking as well. You did see their losses widening, but there are some technicalities to this. Essentially, that was down to the remeasurement of convertible preferred shares. And so that's sort of common, that remeasurement that you see for high-tech growth companies when they have a rapid increase in valuation. And indeed, their stocks pretty much quadrupled since the listing in January. So they've had to change some metrics or some accounting around that. But essentially, lots and lots of demand that they're seeing globally, so around 70% of their sales coming from international markets, and as well a product pipeline that looks quite solid. So they're planning to announce the M3 in the second half of the year, which will be their latest model release as well.
All right, Mel. Thank you. Annabelle Jewelers there with the latest when it comes to Minimax as well, as, of course, these Nvidia chips to China. We're just getting a little bit more. Let's sort of recap some of the market moves that we've seen, right? Things are turning sour, Dave, as we speak. And really, we thought there was a bit of a bounce. And then, Korea came back from that holiday. And I think it's just now led to even spreading this negativity to the likes of Hong Kong, to the likes of Japan. Japan's down some 2% here this morning. There is some concerns on social media about more military action in the Middle East. So certainly that is a cause for people to actually once again press the sell button. This is Bloomberg.
Right, just an update here of the damage we're seeing across these markets. And we're extending the losses. In fact, just about everything is down with the exception of one or two markets. Korea's down 3.5%. U.S. European futures are pointing to a continued sell-off when those markets, of course, come online this Tuesday. Lots more ahead. This is Bloomberg.
$11:29 a.m. in Tokyo. Japanese markets are going on break in just a moment, but we're taking a look at the Hang Seng here right now. We're flat right now, but Tokyo is heading to that lunch break to the downside, where you are seeing risk aversion spread back to Tokyo here this morning. We're down 2% for the Nikkei 225 as well as the topics here. Yen is still slightly on 157 levels as well, so not doing a whole lot of movement. And you're not seeing that really kind of flight to safety into the yen since this Iran escalation. But you are seeing, at least when it comes to JGB yields, kind of following the trend that we've been seeing across fixed income markets, where yields are ticking higher, given the concerns around the shocks in terms of energy prices, what we could see when it comes to oil, which continues continues to be elevated here this morning. LNG markets, that certainly continue to be elevated, what we saw in the European session yesterday. So is there going to be some sort of inflationary scare that bond traders are certainly thinking about that this morning?
Yeah, it doesn't necessarily need to happen. The fact that we're talking about it now is really just adding to the worries out there in this market and why everyone is just really a lot more sensitive and receptive really to bad news out there, given this is an ongoing situation. We're trying to verify some reports of explosions and the like there. Suffice to say, investors are asking questions later and they're selling now. So when you look at the benchmark, we're down about 1.7%. It's the big names you can think of, whether that's a Japanese car maker, a Korean car maker, some of the big tech plays. The other side, though, to the benchmark, and despite the fact that you are getting substantial gains in defense-related names, a lot of the big oil plays are gaining, obviously, given what's taking place. The benchmark is still down about 1.6%, and we showed you earlier on, of course, what's been taking place across the European equity complex with futures on both the SOX 50 and the DAX, including the S&P, E-mini futures, are all pointing to an extension of losses once those cash markets come online later today.
Yeah, and let's not forget, right? It's not just the Iran situation that we have to deal with, but we're also talking about MPC, right? China beginning its most important annual political meeting tomorrow with investors seeking clarity on plans to press ahead with tech ambitions while reviving a fragile consumer economy. Let's go to Beijing now, and our China correspondent, Min Min Lo. Min Min, what are some of the key economic targets we're watching out for this time?
Yeah, so Premier Li Qiang will be delivering the government work report where he will outline the achievements for last year and also the key goals for next year, for this year rather. So for 2026, the key items we are looking out for, of course, is the GDP number, expected to be about 4.5 to 5%, which is slower than last year's around 5%. That tells you that the government may be more tolerant of slower growth in exchange for higher quality growth. It also gives us a sense of the pace and scale of stimulus and how that's going to look like in order to hit that growth target. Of course, the inflation target expected to stay at about 2%. We are currently looking at inflation hovering just above zero, so we're still a long way away from the target. The budget is going to be important as well. The narrow budget deficit expected to be 4% of GDP, which is same as last year, but the broad deficit, inclusive of the issuance of bonds, that's expected to be ramped up. Morgan Stanley, for example, expecting the ultra-long special sovereign bonds to be increased from 1.3 trillion yuan last year to 1.5 trillion yuan this year, and that will give the central government a bit more firepower to inject into things like consumption subsidies and other measures to boost growth. But what's key to watch this year as well is that the government will also reveal the 15th five-year plan, which the delegates will discuss, but it's largely a rubber stamp parliament, so they are likely to approve that plan by the end of the two sessions. And again, that's going to lay out the key priorities for the next 5 years, including number one, boosting high quality growth, and number two, ensuring tech self-sufficiency, and number three, boosting domestic demand, which is one of the hardest things to do in China's economy right now.
Min Min, thank you so much. Min Min Lo, our China correspondent, with that last point, of course, on boosting consumption. Joining us out of New York is Arthur Kroeber, founding partner and head of research at financial services firm Gavekal. Arthur, good morning from Hong Kong. It's easy, the temptation is to look at the growth targets and look at that as perhaps a solution to most of the economy's issues at the moment. How are you looking at the prism of a growth target and the broader challenges of this economy right now?
Yeah, thanks very much. So I think the growth target is basically irrelevant to the problems that are facing China today. And the basic reason for this is that the growth target is expressed in real terms. And right now, real growth has a significant component of deflation in it. And deflation, which is a reflection of these problems of excess supply, insufficient demand, and so forth, is the real problem that they need to be tackling. And the only way that you can address that is by targeting something other than real growth, so nominal growth or the inflation rate. And there really isn't any indication, I don't think, that the government is moving significantly away from its real growth target. So I think basically what we're expecting I'm sorry to say, is more of the same from the Chinese leadership in the current planning cycle.
In terms of consumption, this sort of, the rebalancing the economy away from export-oriented, away from investment-heavy sort of economy has been slow going, to say the least. I mean, in terms of the consumption side of things, what are you expecting this time around?
Basically the same as what we've seen over the last couple of years, which is a certain amount of rhetorical support for this idea that there needs to be more domestic demand, there needs to be more consumption, but nothing really serious that changes the fundamental strategic orientation of the government, which has been very clear for several years. They've said their major task is to increase the technological capacity of the economy, focus on tech-intensive manufacturing, both as a way of stimulating long-run productivity growth and also insulating the Chinese economy from U.S. pressure. And since they're not really changing that overall strategic orientation, they can't really offer anything serious on a major shift towards consumer spending.
Arthur, any points of urgency? And the reason I ask that is the economy doesn't seem to be doing extremely bad, but it's also not doing extremely well. Things are actually okay. But I wonder what specific urgent fronts you think we should be paying attention to, and whether or not you think they'll be addressed at the upcoming NPC.
Well, I mean, to be frank, I don't really get the sense that the Chinese government has a sense of urgency. I mean, I think their assessment is, as you said, there are issues in the economy. The shakeout from the property sector, I think, has taken longer than they would have ideally liked. So you still have the deflationary impact of the property contraction, et cetera. They are concerned about excessive competition or excess supply in a lot of manufacturing sectors, and they're trying to address that. But there's not a high sense of urgency. And the other thing, obviously, that they could be quite concerned about is what we've seen in the Middle East. What does that mean for China's imported energy supplies? And even there, I think the evidence is that they prepared for this quite well. They've stockpiled huge amounts of oil. They probably also have some natural gas stockpiled. So they're pretty well secured against both the crises, the geopolitical crises of the moment, and the longer terms of the economy. So they seem to be basically pretty patient and taking the view that, look, we're making investments in the tech-intensive manufacturing sector for the long term, for the next 10, 20 years. Maybe this will take some time to pay off, but we're willing to make those investments. And if we have to suffer somewhat lower growth and some deflation in the short term, so be it. So I don't really get a sense that the government thinks that there are urgent problems that they need to work really, really hard to correct. They're more sort of management problems.
Yeah, you mentioned about trade. I mean, Arthur, we have this big meeting between Presidents Trump and Xi in just a few weeks, and just adding to the whole Iran situation does add to the complexity of what they might discuss. I'm just wondering, what are your expectations? Is there, anything beyond just what we saw in APEC in South Korea, the truce there? Could we see anything more than what was achieved there?
Right. Well, I think there are two questions. The first question, obviously, is given what's going on in Iran right now, is the meeting going to take place? And I think some people had some questions about that. My sense is that the Chinese really want this meeting to occur. They place a large value on stabilizing a relationship with the United States. Their relationship with Iran is fundamentally pretty transactional. They don't have a lot invested there. So my expectation is that despite the drama there, the Chinese will choose to go ahead with this meeting. And then the second question is, what do we get out of it? I think from the Chinese standpoint, they would be happy for, some stabilization of the relationship, an extension of the truce, the reduction of tariffs. Obviously, that's a lot easier now that the Supreme Court has ruled that a lot of these tariffs on China are illegal. So the Chinese negotiating position on that has improved quite a lot. And again, from the Trump administration, I don't really get the sense that the ambitions are very high. Again, I think for Trump's perspective, he doesn't see that any conflict with China will serve him well in the midterm election campaign, so he just wants a stable relationship. I think he would want some more commitments on Chinese sales of rare earth elements and other critical minerals to the U.S., so they'll be pushing pretty hard for that. But for the most part, I think we're just going to see an extension of the truce. The most interesting thing to watch will be whether they can make any progress on creating a framework for increased Chinese investment in the United States. I think that's something the Chinese would like. Politically, very difficult to pull off in the U.S. So I think real questions on the U.S. side whether Trump would go that far.
Arthur, thank you. Arthur Kroeber there, founding partner and head of research at financial services firm Gavekal, joining us there from New York. Going back to the market itself, we've been seeing, of course, some of the biggest drags we've seen has been, of course, these Korean markets and them returning back from that holiday. And you are seeing that sort of catch down story with Samsung, with SK Hynix, both down some 5%. Toyota also is down another 5% here today. Certainly, there's going to be a lot of questions on why we're not seeing that sort of dip buying. Let's bring in our Lianting Tu, our Asia Equities Managing Editor, to join us out of Singapore for more on this. We have seen things turn quite to the negative in the last few minutes or so. What are you hearing from some of the sources and the like about what really sentiment is like now?
Yeah, I think people are now starting to realize that the end game for this war is just very uncertain. Nobody seems to know that how the end game will be. And we saw Howard Marks in Sydney saying the same thing, that there's just a lot of uncertainty around this particular matter. And that last night, U.S. traders traded the market as if the war's going to be short-lived. And now people are realizing that this view is way too optimistic, and quite a few bearish sort of commentary has come out, and bearish headlines also hit the wire. The latest was that U.S. official says it's impossible to strike a deal with Iran. Again, that points to the issue, how long this war is really going to last. And we saw Sok Jen talking about how European equities will be the worst hit in the next 6 months period. And we've got Vantage Asset Management talking about how this war is happening when global equity valuation is at a very elevated level. That also means the unwinding or the sell-off could be more drastic. That's why we're seeing sort of a second day of very intense selling. You guys mentioned Korea, and also Taiwan is seeing a sell-off too. So some of the recent winners are now seeing profit taking in a very big way.
Yeah, you mentioned Lianting, European futures were down 0.5%. Talk to us about the Chinese markets, because clearly local relations do help in a situation like this, and we're not in fact seeing some of these benchmarks move to the upside. I think the Hang Seng Tech, which is still in a bear market, managed to claw back the 5,000 level. How are you guys covering China today?
Yeah, I think there is a bit of a dichotomy going on in China. We're talking about mainland China and the Hong Kong market. If you look at mainland China, there are quite a few beneficiaries, right? The index-heavy energy, financial, and also shipping companies. Those are sort of the beneficiaries. Energy stocks, I believe, did really well yesterday and also doing very well today. And shipping, for example, Costco shipping was touted by Goldman as one of the key beneficiaries in this Middle East conflict. But if you look at Hong Kong, there's just the sell-off couldn't catch a break. Again, I think we're seeing quite a slew of earnings coming out soon. Bilibili would be the next one. I think we still don't have a certain date for Alibaba, but that's going to be a milestone that everybody's watching out for. And there is also concern that ByteDance, it has very advanced AI applications and technologies. That seems to be really leading the way in onshore sort of AI race, which means the likes of Baidu and Baba are seen to be falling behind. So that seems to be a new narrative that is playing out right now that's causing concern among all these internet names listed in Hong Kong.
Lianting, thank you so much. I know we scrambled you to the camera right now. We're trying to figure out, to your point, right, why markets are kicking off. It could be very, very simple, as Lianting is pointing to right now. Our Bloomberg Video Hub, by the way, subscribers can explore live streaming. Here's the plug. News, interviews. Check it out, bloomberg.com/videos. Welcome back, and apologies if we're just looking down here. More lines are coming through, an update coming through out of the Middle East here. So number one is Saudi has now said it has intercepted 8 drones near Riyadh and Al-Kharj. That's according to the Saudis. We're also getting more lines coming through on the energy space, but we're also looking at, of course, developments in the U.S. Embassy in Riyadh, which was attacked, of course, by drones, I understand.
Yeah, so hence you had that kind of shelter-in-place sort of alert that came through just the last hour or two or so. So that certainly is still a key concern. I think that's why you are seeing risk assets on offer once again here and extending declines that we saw yesterday. There also is that sort of gas and energy story, which continues to see gas prices and oil prices quite elevated here in the Asia session. You are hearing more from some of these Asia nations about how are they securing alternative LNG supplies. In the last couple of minutes, South Korea saying that they are seeking alternative LNG supplies after this Qatar halt in production here. Also, we're hearing from the Philippines saying that right now they are having sufficient oil supply. So certainly when you take a look at what we saw when gas prices yesterday in Europe, we'll see how Europe does when they wake up this morning, whether we see another round of this. But yes, it brought us back to levels that we saw maybe, or moves that we saw 4 years ago. But when you talk about the impact that the Russia-Ukraine war had on energy, I think was much bigger. And our columnist Javier Blas has a great column out saying that maybe that the hit to LNG will be short-lived because it seems like Asian nations are a little bit more well prepared this time around.
Well, more diversified.
You take a look at China, for example, right? They are the biggest importer of LNG, but they can switch to coal, he says. They can switch to hydropower, solar, if need be. South Korea might be another sort of problem, but then again, you have Japan that's also helping in terms of the power generation and so yeah, there are maybe more alternatives this time around.
Well, yeah, to your point on the Koreans, right? They might be standing out as far as the pain point is concerned. Well, that really goes nicely into this next discussion in terms of the Chinese angle and really the stance as it pertains to what's happening in the Middle East. So you have the foreign minister, Wang Yi, calling on Iran to pay more attention really to the reasonable concerns of its neighbors. It's after, of course, retaliation coming on the part of Iran against U.S. and Israeli attacks, included strikes on Qatar, the UAE, and Saudi Arabia. The ministry says Wang spoke by phone with his Iranian counterpart, Abbas Araghchi, reaffirming China's support for Iran's sovereignty and territorial integrity.
Yeah, let's bring in our Bloomberg opinion columnist Karishma Vashwani saying that Beijing's muted response to the Iran conflict is a signal that it can manage any leadership shakeup as long as the oil keeps flowing. She joins us now from Singapore. Karishma, great to have you on the program. You argue that China sees Iran as a transactional partner, not an ally. What do you think of Beijing's muted response, first and foremost, and what does it tell us about the broader strategic play here?
Yeah, Yvonne, in my research for this column, somebody suggested that China's strategy right now is akin to an ancient Chinese military phrase, when two tigers are fighting it out, it's better to sit on a mountain and wait and watch. And I think that's something that President Xi Jinping must be thinking about quite keenly right now. I mean, I think we should be really clear as well that the energy supply issues are, of course, a problem for China. I think that caveat needs to be made. But as you pointed out, from my colleague Javier Blas's column, both in terms of conventional energy as well as LNG, these are issues that can be mitigated. And fundamentally, the way that Beijing operates and looks at relationships is transactional. It's about securing economic and strategic interests. It doesn't think of alliances the way you would think of an American foreign policy, with regards to sort of military guarantees or security guarantees. Any suggestion that there would be some sort of swooping in by the Chinese to rescue Iranian clerics, or for that matter, Venezuela's Nicolas Maduro earlier in the year, I mean, that simply just is a misunderstanding of how China operates. Instead, what we have seen this time round, as well as during the conflict last year between Iran and Israel, are statements, official statements, calling out what China believes to be a violation of international law, as well as the fact that it wants Iran, I think this is particularly interesting, to exercise restraint while recognizing that there have been severe violations of international law at play. But I think that underlines the game that China is playing in this situation and the interests at stake.
Karishma, you also, I think, outlined the rationale behind if, that Beijing could stand to gain if Washington gets drawn into, of course, their attention into the Middle East, the attention, resources, and what have you. What kind of opening do you think that might create for China, and how quickly do you think it could, well, separate question, take advantage of that opening?
Well, I think, to look at this in sort of a binary, China is winning or China is losing is, again, it's sort of it lacks the kind of nuance that we need for this situation. I think a better way to frame this is to look at what China cares most about. And in this situation, it's Taiwan, right, David? We've got that Trump summit with Xi Jinping expected at the end of the month. On the table, of course, is the extension of the trade truce that the two sides struck last year. Xi Jinping will not want Iran to become a distraction or in any way a new flashpoint between the U.S. and China. And Taiwan is the key issue for him in terms of his political legacy. Now, if the U.S. continues to be distracted in the Middle East, what that means for China is that it can continue to gradually, with the way that it's been doing in the last several years, with its gray zone exercises in the Taiwan Strait and in the South China Sea, a distracted United States is a very useful opportunity for Beijing.
Karishma, thank you. Karishma Vaswani there, a Bloomberg opinion columnist. Make sure to check out her column here this morning. And subscribers can get more on the Iran conflict as well in today's Big Take, as Trump's move ushers in an era of unrestrained U.S. power. For terminal clients, the function is NI Big Take. It's also available on the website, Bloomberg.com.
Okay, so we're looking at markets before we wrap up the show, and I think there's been an emerging theme that's come up, surfaced in the last hour or so, and that policymakers this part of the world are trying to game out scenarios. If energy prices continue to go up and remain elevated, what offsets can they offer? So as far as the Aussies are concerned, we've talked about the RBA and a policy switch. The Philippines is also coming out. This is out of the president talking about how if oil exceeds $80 a barrel, they're eyeing a potential cut to excise taxes to then blunt the blow of higher energy prices and not see that feed through into inflation into the broader consumer there.
Yeah, and then just adds into sort of the inflation fears that we're seeing across these markets here right now. When you're talking about, a U.S. administration that is really unclear about the timeline of, how long this conflict is going to last. Is it going to be 4 to 5 weeks? It's not going to be endless, but what does that even mean at this point? I think there is, you're seeing Asian nations starting to scramble here on what they can do. We talked about China has a bit of that cushion, right? Just given that what they have, but other nations might not have that. So certainly, are these sort of inflation scares, justified in some ways? Certainly, there's going to be a lot of lingering questions on that side of things. But yes, you start to see when it comes to Fed rate cuts and the possibility of that has been pushed back substantially in the last 24 hours. That's it for us in the China Show. Insight with Heslin Ahmed is next. Stay with us.